So I have a story for you. It's a grift inside of a con, inside of a shell game. And our protagonist is none other than Donald John Trump. Although nothing I'm about to tell you about this con of a lifetime is illegal. And that's the point. This story goes well beyond Trump, but as usual, he takes everything crooked to another level. So we're going to accomplish a couple of things today. The first is to explain how Trump's media company, Trump Media and Technology Group, was able to purchase $400 million of its own shares recently. We'll talk about the why and how of it all, what the company does, and how it feeds into the Wall Street shell game of stock buybacks that are propping up the equity markets right now. But again, the salient point is that nothing here is illegal. But if you're among the tens of millions of Americans who know the game is rigged, but you can't quite put your finger on it, this is a pretty good example. For the MeidasTouch Network, I'm Max from UNFTR. So let's go.
Trump Media and Technology Group, the parent company of Truth Social, announced a stock buyback of up to $400 million, causing shares to rise about 3% in pre-market trading.
So there's a very good chance that you're not on Truth Social, the centerpiece asset of Trump Media Group. X has 300 times the daily users. Even Blue Sky has 10 times the number of daily users. And yet, the company that owns it is so well capitalized, it was able to buy back $400 million of its own shares. There's so many questions that need to be answered to explain this, so here's how we're going to break it down. We'll start with Truth Social itself and dive into the company structure and revenue. Then we'll show how Trump was able to secure billions in funding to get it off the ground. And then we'll talk about the buyback itself, why they did it, and the real purpose behind this so-called media company. And you'll see for yourself that it is indeed a grift inside of a con, inside of a shell game.
And it's an astonishing windfall for Donald Trump. His fortune just skyrocketed as Truth Social stock takes off.
Shares are soaring.
This is pretty extraordinary.
Shares in Truth Social started trading Tuesday under Trump's initials, DJT.
When Trump Media went public with only Truth Social to hang its hat on, there was an initial frenzy in the market because there was speculation at the time that Trump might be elected to a second term. It was a long shot gamble that hasn't paid off for anyone really, except for the cast of charlatans behind the issuance, and of course, Trump himself. Despite the chest thumping about great technology and Truth Social taking over the social media world, the reality was quite the opposite. Gamblers and Trump sycophants poured money into the stock anyway, but savvy investors knew from Jump Street that there was no there there.
2 words, GameStop.
GameStop. That's what you think is going on here?
It's ridiculous.
The
company has no revenue.
But do you think it could ever be a bigger business? Do you think if he wins the presidency, it becomes...
Why?
Diller and anyone with a pulse and a brain saw right through it from the start. And a year later, the numbers tell the story. This is ripped directly from the company's most recent quarterly filing with the SEC. Net sales for the quarter ending March 31st of this year show that Trump Media brought in a paltry $821,000 in revenue. For comparison's sake, Meta's Q1 revenue was $42 billion. So this puts Trump Media on pace to hit about $3.2 million this year. Even more ridiculous is that to pull in that $821,000 in revenue, it cost the company $40 million. So it lost $39 million for the quarter. Trump's Truth Social has been a disaster from the beginning. First off, it's lousy tech. Second, it's bleeding cash, and there's no appreciable revenue model in sight. So it begs the question, how on earth was this company even able to go public in the first place? And here's where our story really begins, and the first scam is revealed.
Trump Magazine, Trump Vodka, Trump Airlines, Trump Steaks, Trump Water, Trump Mortgage, Trump Travel, Trump The Game, Trump Casinos, multiple, Trump University, Trump Foundation, and now the United States economy. Those were all entities that went out of business or that Donald Trump had to declare bankruptcy for because he is a failed business person. And if you want to just look at Donald Trump's financial filings before the SEC regarding Trump Media, you have to disclose your bankruptcies and business failures by law. So they list it right there.
Truth Social's holding company, Trump Media, was a failure in search of a sugar daddy. And boy, did it find one. Trump Media merged with a company called Digital World, a startup investment vehicle referred to as a SPAC, which stands for Special Purpose Acquisition Company. So these are publicly traded investment vehicles created for the sole purpose of acquiring or merging with an existing company, effectively taking that company public without having to go through a normal IPO process. So SPACs have been around for several decades, but they only gained popularity in the early 2000s. And they're referred to on Wall Street as blank check companies because that's essentially what they are. They're just money in search of an idea. So even though the first one was launched in 1997, it wasn't a popular vehicle because of the risks associated with it. It wasn't until a tech bro named Chamath Palihapitiya got involved that the SPAC world was set ablaze. So what Chamath and others figured out was that high-profile people, from celebrities to Wall Street titans, could just skip the hard part of going public and get listed with just a filing and a promise. So if they could get Brad Pitt to fart in a paper bag, they could get money to invest in it. The initial investors come in at very favorable terms, typically with something called warrants, which allows them to purchase extremely discounted shares of the SPAC once it's listed on an exchange. The trick here, however, is all about timing. The SPAC usually has a limited amount of time, somewhere between 12 and 18 months, to identify an acquisition. So the funds are held in a trust account until the SPAC identifies a target company to acquire. And once the target is identified, the SPAC undergoes a merger or an acquisition, effectively taking the target public. So if the SPAC fails to complete an acquisition, though, within a specified time frame, it has to return the funds to the investors. Now, it should be noted that regulators hate these vehicles. I mean, hate them. Like every other public company, SPACs are subject to regulation by the SEC and other regulatory bodies. It's just like every other public company. So with each passing year, the SEC has been trying to make it more difficult for SPACs to maneuver because they mostly suck. For example, literally none of Chamath's SPACs ever worked out. In fact, they've been a disaster. The ones that survived the holding period are down significantly, and others either just closed or never got off the ground, which has made Chamath somewhat of a pariah in investment circles. But back to the crucial investment window. Digital World was able to meet the first threshold by merging with Trump Media, and that's how it was able to hit the ground running on an exchange. But at some point, the company also has to perform. Otherwise, it's just a pump and dump scheme.
Trump Magazine, Trump Vodka, Trump Airlines, Trump Steaks, Trump Water, Trump Mortgage, Trump Travel, Trump the Game, Trump Casinos, multiple, Trump University, Trump Foundation, and now the United States economy.
But we'll get to that part at the end, because as it turns out, they actually do have something up their sleeve. And it's not about making Truth Social profitable. Once again, the chief grifter in charge had to pony up little, if anything, other than his name. In return, he received extremely favorable terms on his investment of nothing. Now, according to some analysts, just the cash portion of what he received once it went public was in the hundreds of millions. And because he's such a stable genius who surrounds himself with only the best people, you can imagine the clown car of shysters who got this thing off the ground. So the original CEO was a guy named Patrick Orlando, whose impressive resume includes a defunct biofuel company in Peru, a deal with Venezuela to finance tugboats, and another venture in China. So the only real record of his accomplishment is the treasure trove of lawsuits left in his wake. But he did have enough to muster $25,000 in the original investment into Digital World. And he also knew how to organize a SPAC. So his stake was purportedly worth around $600 million when he was fired. Then there's Luis Orleans Braganza, the founding CFO of the company, and a huge supporter of Donald Trump, who also maintains close ties with Jair Bolsonaro. Oh, and he's no longer with the company. We've got Bruce Gerlich, who was on the founding board, and the SEC filed charges against him for trading in advance of the SPAC announcement. And another fancy term for that would be insider trading. And rounding it out, we've got founding board member Justin Shaner, who was subpoenaed by the SEC last year, and Brian Shevland of Bluestone Capital Management, also a founding board member who was suspended by the SEC from acting as a broker. Only the best people. So now that you know how they pulled off taking Truth Social public despite having no revenue, losing hundreds of millions of dollars, being built on horrible technology, and no plans to become a real business, let's talk about that $400 million buyback that's part of a wider trend that has implications for the economy and will illustrate just how rigged the system truly is. See, buybacks are very much in the news today because in April, U.S. corporations announced a staggering $233 billion in stock buybacks, the second highest monthly total ever recorded. But unlike previous buyback bonanzas, this isn't a sign of corporate strength or confidence. It's quite the opposite. This time, it's a bit of a red flag. Companies aren't plowing this cash into their businesses because they see amazing growth opportunities. They're not investing in innovation, in workers, or expansion. Instead, they're spending billions to prop up their own share prices in a cynical bid to boost executive bonuses tied to stock performance. Take a look at this chart from the Fed. What you're looking at is the mountain of cash that corporate America is sitting on. So you can see post-pandemic that the figures have gone into the stratosphere. Now, the trend was already on the rise since the global financial crisis when the U.S. government poured trillions of dollars into the system. Trump's tax cuts and a low interest rate environment allowed companies to score record profits and then hold on to most of them even after they've begun declining. Then you can see during the pandemic, they scored again and pocketed a historic amount of cash, all while increasing prices on the consumer to make sure they took what was in your pocket as well. Things cooled off a bit during the inflation spike when the consumer finally hit a wall, but as you can see, they've come back with a vengeance. Now, you might think that corporations are absolutely killing it by looking at this, but there's more than meets the eye here, and it explains the relentless pace of buybacks. According to the St. Louis Fed, corporate America came into the year with $209 billion in cash reserves. Now, this kind of dough can be used to issue dividends to shareholders, invest in projects, pay down debt, bonus employees, invest in the market, just chill out for a rainy day, or purchase back shares of its own company. And that's what we're seeing in 2025 in a significant way. You see, corporate America has been so drunk on free Fed money for so long, while getting used to fleecing the American consumer, that it's hiding the fact that today, they're not as profitable as the cash on hand picture would indicate. So this is something called the Shiller PE ratio chart that tracks earnings per share of public corporations on the S&P 500. And the easiest way to understand this is the higher the line on the chart, the less profitable a company is relative to its share price. So you can see the first spike is in 2000, the dot-com bubble. Now, if you're hesitant about the rush of capital into AI stocks, then you probably lived through this period. This is when any company with a .com at the end was flooded with investment money, even if it was a turd like Truth Social. And after the crash, PE ratios came back down to earth, and you could see the valley during the global financial crisis. But as you know, the stock market has been on a never-ending climb since that time. So you can see the two highlighted areas are the inflation crisis and right now, during what we should start calling the Great Trump Recession, because we're already in it. The stock markets are hitting record highs because investors have nowhere else to go. So even though inflation was through the roof under the Biden administration, the market cranked. And it's hitting all-time highs these days as well. But the Shiller chart shows in black and white that the emperor is butt naked right now, with PE ratios almost at pre-dot-com bubble peaks. So as we've said, one of the ways the companies influence share price to make it look better is through these buybacks, because it reduces the number of shares that are outstanding. And it's rampant these days, which is why the chart looks like that. And it's really underhanded. So much so that it used to be illegal. And hold on to your hat when I tell you who made it legal.
Oh, yeah.
That's right, it was me, the Gipper. In 1982, John Schad, the SEC chair under Reagan, implemented Rule 10b-18. And this rule gave corporations a green light to repurchase their shares without fear of being accused of market manipulation, so long as they followed some pretty permissive guidelines. It was deregulation at its finest, another win for the free market fundamentalists who dominated economic policy through the 1980s and through the 90s and the 2000s and forever. Anyway, by the early 2000s, S&P 500 companies were spending more on buybacks than on dividends. And by 2007, S&P companies were spending nearly 90% of their earnings on share repurchases and dividends, leaving precious little for investment, research, or workers. But if Reagan-era deregulation opened the door to buybacks, it was Clinton-era tax policy that turned them into an executive compensation bonanza. In 1993, the Clinton administration pushed through Section 162M of the IRS tax code, and like so many other new Democrat initiatives, on the surface, it sounded progressive, aimed at reining in executive pay, because the law capped the corporate tax deductibility of executive compensation at $1 million per executive for publicly traded companies. So problem solved, right? Wrong. The law included a massive loophole. Performance-based pay, such as stock options and bonuses, were exempted from the cap, and the results were exactly the opposite of what was ostensibly intended. Rather than limiting executive compensation, Section 162 caused it to explode. So companies just capped salaries at $1 million and shifted compensation to stock options and performance bonuses tied to, you guessed it, stock price. An SEC study found that executive sale of personally owned stocks increased from an average of $100,000 per day to $500,000 per day immediately following their company's buyback announcements. In other words, corporate executives are using company money to pump up stock prices and then personally cashing out at those inflated prices. Of course, Trump is not the president, not the CEO of Trump Media, so executive compensation doesn't matter to him, right? Nor does he actually control the shares. Some other idiot does at the moment, but he is the sole beneficiary, so when the stock goes up, so does the value of the holding that will eventually come back to daddy. So now we've got the grift, which is the SPAC, inside the con, which is pumping the value through buybacks, which leaves the shell game. And it was only a matter of time before we found out what it was, and now we know.
Many Democrats have said that they are not going to support crypto bills in Congress only because of you and your family's personal crypto ventures. And these votes are in some cases needed to pass.
And there it is. Whether the GOP gets anything done on crypto-specific regulations is a footnote. As you can see here, the crypto market responded pretty enthusiastically to the passage of the big, beautiful bill for two very cynical reasons. The first is that very wealthy people are going to have a lot more disposable income, which means they'll be more inclined to invest in riskier assets with some of their money. And because economic data is degrading so rapidly and the big ugly bill is going to obliterate consumer spending and drive us into a deep recession, speculative assets like gold and Bitcoin stand a good chance to see a flood of hedge investments. Okay, so what does this have to do with Trump, Truth Social, and the SPAC? Because Trump Media just filed paperwork seeking approval to launch an ETF to invest in Bitcoin and Ethereum. A little boost to the share price with the buyback to pad the pockets of the initial investors, and a plan to roll the remaining $2.5 billion into crypto. And with that, the shell game is revealed. Until next time, I'm Max from UNFTR for the MeidasTouch Network. You can find me at UNFTR on YouTube or visit UNFTR.com to sign up for our free weekly newsletter. And I'll see you in the next video.
Oh, yeah.
Can't get enough Meidas? Check out the Meidas Plus Substack for ad-free articles, reports, podcasts, daily recaps from Ron Filipkowski, and more. Sign up for free now at MeidasPlus.com.